Good morning, everybody. Mike Tedeschi over at Perspective Wealth Planning. In this week's video, we have a lot to cover. This week has been absolutely historic, and what I want to start with, guys, is talking about limit down. It's something that's happened twice this week. The last time we had a limit down event was actually the night that Trump was elected. And what that means is the market has a maximum price that it is allowed to fall outside of U.S. trading hours. That is 5%. So the price has gone down 5% overnight, Sunday into Monday, and once again it's down 5% going into Thursday's trading session. You can see right here we just opened up. The limit price down was 2,600, and now we are subsequently falling below that. The next circuit breaker is minus 7%. If the market hits minus 7%, trading will halt for 15 minutes. That happened on Monday. We haven't seen that happen in forever. The next level after that is minus 13%. If markets go down 13%, they get halted once again for 15 minutes. And lastly, during the U.S. trading session, 20% is the maximum. If the markets fall 20%, the markets will be closed for the rest of the day. We have never seen anything like the volatility and the action that we have seen this week. Let's jump right in now. Let's talk about key levels. We're right at one. You just watch the market open and fall right to that 2550 zone here on the S&P 500, and that is what we are watching for. The next level after that's going to be 2330. And below that, we're going all the way back to that major breakout back in 2016, and that's that 2100 level. So those are the major zones that we're paying attention to on the S&P 500. When we take a look at the Dow Jones here, the Dow Jones is right back at December lows this morning after that opening selling. That's that just under 22,000. A next level of support comes all the way back in at that breakout zone at 18,000 and some change. So there's not a whole lot between right here and our next major level down. The Russell, on the other hand, is actually now below where it was in 2008. We can clearly see how much we have fallen. Underneath of that level, our next support level comes in at 1160, and then below that we're talking about 1080, and then we have to go back to the lows from 2016 all the way back at 940. So it looks like every other index right now is trading except the Russell, which actually hit that 7% lock limit down. So the Russell's actually been halted at the moment this morning. Next, we'll take a look in at the Nasdaq. The Nasdaq had been much stronger than the rest of the indexes. Our support levels are 7350. Underneath of that, we're talking about 7,000, and then below that, we go back to that 5,800. The moves that we have seen here over the last couple of weeks have been nothing short of historic, and in fact, we're going to take a look at a couple of different ways of looking at this information and discuss exactly how historic and violent this move actually has been. So, the tick, if you watch what that is, it's talking about number of stocks down versus stocks up. So it's a way to look at selling pressure, and the only time that we have seen a higher intraday low on the tick for the New York Stock Exchange was actually right after 9/11. So this, again, worse than all the selling pressure that we saw in the 2008, 2009. This is absolutely historic what we have seen here in terms of selling. Another way of talking about how absolutely historic this is, there has never been a stretch with more negative opens. We have just unbelievable gap downs over and over and over again. The pessimism at the open, the violence that we're seeing in terms of moves to the downside has never been matched before. In fact, this is the quickest that we have ever gone from a bull market into a bear market, and I'm going to visualize that for you here as well. If we look at the S&P 500 from its last high right before a recession and ultimately into a bear market, we have the charts of every single time that that's happened. The blue line that you see here is us right now. And you can see the move that we have had to the downside far surpasses any of the other ones. It's not even close. And again, we just opened down another 5+%. Once again here today, actually down 7%, almost 8 right at that 7%. The Russell's down 8.5% right now. So again, these numbers and these lines are going to be, even lower than they were. So the violence in the move to the downside has never been matched before in history. This is absolutely historic. I want to talk about what is going on and try to think about things a little bit positively here. So this has obviously been just an absolute destruction of wealth here over the last couple of weeks. And when you start thinking about a pandemic, something that's going around the globe, it is massively going to impact global trade, and that is what we're seeing. We're seeing countries shutting their borders. We're seeing schools get closed. We're seeing workers get sent home, right? This obviously is not good in any way, shape, or form for the ultimate economy. But if we look at pandemics and we look at their history, right, they are a short-term phenomenon. They do not last for years and years and years and years, right? And the reason is because of the way in which our immune system works. When a new virus goes through the population, nobody has seen it before, nobody is immune from it. And that is the reason why essentially it runs like wildfire throughout the population. But the second time something goes through the population, a lot of people ultimately have seen it. They have antibodies, and subsequently we as a group of people are a lot more protected the second time something goes around. It's the reason why every year when that seasonal flu comes around, not everybody gets sick from it, in the same way that if it's a brand new strain that nobody has ever seen. So when we look at what's going on right now, massive short-term pain. There's no other way to take a look at this, right? Everybody at this point in time is closing up shop. They're, quarantining themselves in their houses. They're really, really concerned here. Over the next few months, things are probably not going to be much better. But when we get past this beginning portion here, right, this is not going to be something that 2, 3, 4 years out down the road that we're still talking about the coronavirus. It's going to have a major impact to individual companies. There will be bankruptcies. There will be a lot of issues ultimately that come from this. But if we look at the global trade and way in which the world works moving forward, right, this is not going to be something 3, 5 years down the road that, again, we're still going to be talking about. So the positive is if you have a long time horizon, if you're talking 15 years to when you retire, this is going to be one of those things that's going to be short-term pain, but in the long run, just like the '08 housing crisis, etc. 10 years down the road, it's way in the past, and the market subsequently are higher because of it. If you have short-term obligations, the risk that you have in this market at this point is extremely high. And you need to really think conservatively about when you need capital, and really plan for how you're going to get from where you are today to ultimately your long-term goals. So the only positive light that I can really shed to this, guys, is that years out from now, this is something that again is probably going to be in that rear view mirror. But in the short term, there's really not a whole lot positive to say. The other thing that we hadn't talked about was the massive oil shock that we had. We have talked many times about this 42 level on crude. We talked about 50 and then 42 as those major levels, and if we go back, that 42 was really important going all the way back into 2016. On Friday, we closed right around that 42 level. Over the weekend, Saudi Arabia decided to basically cause a price war over oil for the rest of the world. They want to do away with OPEC and really provide some pain there. So they decided to flood the market with oil and decrease their prices, and that led to a 35% move lower on oil over the weekend, which is unheard of. And that's part of the reason why, not just the coronavirus, but this oil shock is another reason why this week has been so bad on the U.S. exchanges. And the reason is oil is throughout our entire economy. We have a ton of energy production inside of this country. Almost none of these producers make money at $30 a barrel in terms of oil. So all of the loans that are outstanding on these companies, they are now all subsequently in danger of being defaulted on, which really impacts all of the regional banks across the country. And this, if oil prices stay depressed like this, is going to cause a wave of unemployment inside the oil industry, bankruptcies there. It's going to cause issues in terms of regional banks, and it's going to spread throughout the economy. So that is another major concern that everybody is having based on what where the price of oil is at this moment in time. So the things that we're going to be paying attention to moving forward, guys, news flow in regards to countries, whether they're going to be opening up their borders, closing their borders, to world trade. We're going to be paying very close attention to the price of oil. All I can say out there is stay safe, and always continue to manage your risk. And again, if you have a long-term time horizon, I would not be panicking over this. If you have a short-term time horizon, you really need to think about ways in which to protect your capital and protect your wealth at this point in time. If you have any questions and you want to talk about any of this, feel free to pick up the phone and give me a call. You can reach me at 814-580-9881, or you can shoot me an email to mtedeschi at Perspective Wealth Planning. I'd be more than happy to discuss what is going on as of late with you guys. I hope you guys stay safe out there. I'll see you all next week. Take care.